How to adjust a losing naked put. Have you ever found yourself in a tough spot with a losing naked put? You're not alone, and today we will discuss how to adjust that position effectively. A naked put is when you sell a put option without owning the underlying stock. This strategy can expose you to significant risk if the stock price falls below the strike price. So, what can you do when things start to go south? First, consider rolling the put down or forward. Rolling down means you buy back your current put option and sell a new put at a lower strike price. This can reduce your exposure to assignment, but keep in mind it may cost you a smaller premium or even a debit to close the original position. On the other hand, rolling forward involves buying back the current put and selling a new one with a later expiration date. This gives your trade more time to recover, but it also extends your risk exposure. If the stock price drops sharply, you might want to close the position early. Buying back the put option locks in your loss and prevents further downside risk. This is a good strategy if your original market outlook no longer holds or if you prefer to cut losses rather than wait for a potential recovery. Another approach is to use tighter or looser stops. Tighter stops mean you close the position quickly at a small loss, which can reduce your average losses. However, this might result in frequent small losses. Looser stops allow you to hold the position longer, accepting occasional large losses, but this can lead to a higher win rate as many trades recover over time. You can also convert your naked put into a vertical put spread. This involves buying a put option with a lower strike price. This adjustment caps your maximum loss because the bought put limits your downside risk. While this reduces your potential profit, it provides defined risk, which can be a smart way to manage a losing naked put. Always keep an eye on market conditions and implied volatility. Adjustments should take into account current market volatility and any upcoming events like earnings announcements. High implied volatility can increase put premiums but also the risk of sharp price moves. Adjusting your strikes or expirations around such events can help manage risk effectively. Finally, remember some practical considerations. Monitor the underlying stock price closely in relation to your strike price. Decide if you want to be assigned the stock or prefer to avoid assignment by rolling or closing. Make sure your position size is small enough relative to your portfolio to withstand potential losses. Adjustments start a new trade with new risk and reward profiles, so they do not erase the original loss. Adjusting a losing naked put involves rolling the option, closing the position, converting to a spread, or managing stops based on your risk tolerance. These actions requiring continuous monitoring of the underlying stock price, market volatility, and your overall trading plan to balance risk and reward effectively.